Trading ratio spreads using option Greeks. Have you ever wondered how traders manage to profit from options while balancing risk? Today, we will explore trading ratio spreads and the role of option Greeks in this strategy. A ratio spread involves buying and selling options on the same underlying asset, but with different strike prices and the same expiration date. The unique twist is that the number of options sold is not equal to the number bought. For instance, a common ratio is one option bought for every 2 options sold. This creates a distinct risk and reward profile compared to standard vertical spreads. To trade ratio spreads effectively, understanding the option Greeks is essential. The Greeks measure how sensitive option prices are to various factors. Let's break down the main Greeks you should consider. First, we have delta. Delta measures how much the price of an option changes when the underlying asset's price changes. In a ratio spread, the net delta position can vary based on the number of options bought and sold. For example, in a call ratio spread where 1 call is bought and 2 calls are sold at a higher strike, the overall delta can be positive or negative. Traders use delta to gauge their directional exposure and adjust their positions accordingly. Next is gamma, which measures the rate of change of delta relative to the underlying price. Ratio spreads can have complex gamma profiles because of the different strikes and quantities involved. This can lead to nonlinear risk, especially if the underlying price moves significantly. Monitoring gamma helps traders anticipate how their delta exposure might shift as the market fluctuates. Then we have theta, which represents time decay. Options lose value as expiration approaches. In ratio spreads, traders can benefit from positive theta if the options sold decay faster than the options bought. If the underlying price stays near the short strike at expiration, the sold options can expire worthless while the long options retain value. Lastly, we have Vega, which measures sensitivity to changes in implied volatility. Ratio spreads are often used when traders expect implied volatility to decline. Since more options are sold than bought, a drop in volatility reduces the value of the sold options more than the long options, benefiting the position. However, rising volatility can increase risk. When applying the option Greeks in trading ratio spreads, consider these practical steps. Use delta to set your initial directional bias and size your position. Monitor gamma to anticipate changes in your risk profile as prices move. Take advantage of theta to benefit from time decay, especially if you expect the underlying price to stay within a certain range. Manage your Vega exposure by entering ratio spreads when implied volatility is high and likely to decrease. For example, in a call ratio spread, a trader might buy 1 into money call and sell 2 out of the money calls. This position can profit if the underlying price rises moderately to near the short strike at expiration. The trader benefits from theta decay and favorable changes in implied volatility. However, if the price rises sharply beyond the short calls, the trader could face significant risk due to the extra calls sold. In summary, trading ratio spreads using option Greeks involves balancing the sensitivities of your position to price changes, time decay, and volatility. Successful trading requires careful selection of strikes and ratios, constant monitoring of the Greeks, and adjustments to manage risk while maximizing potential reward.